we are live here on the day that everybody makes an incredibly big deal out of because it's the most important day of your life. It is the most important Fed meeting since the last one and until the next one. But this one actually has some special significance, which we're going to talk about today. The 25 basis point cut has already been approved, but that's not the story. The story is that it is what they call a hawkish cut. What could that possibly mean? We're going to talk about that. Also, what is happening with the Lisa Cook case at the Supreme Court for the Federal Reserve, and how that's going to play into everything. What about Kevin Hassett taking over the Fed? When's that going to come into play? Is that really going to happen? And a whole lot more. I'm Cairo Copeland. This is Reinvent Ideal, and you are watching Shut the FUD Up. Getting started a little early today because the press conference begins at 2:30, and what we want to talk about first is the actual story itself here, which I'm going to bring up. We'll get into that, but let's check out what's happening in the market and how they're absorbing all of this news here. We see Bitcoin is up a little bit from where it was, not really anything to write home about. Here's what's really impressive about these past few days is look at Ethereum. My gosh, it's actually doing something good for the first time in who knows how long. And this, by the way, I think is also the reason why the Pulse Chain ecosystem has had a good couple of days, is because Ethereum's had a good couple of days and we're just so heavily paired to it. Not just this year, but also if you look at the Ethereum Bitcoin pair itself, that has also experienced a little bit of a breakout, which is bullish for everything else besides Bitcoin. Rest of the market looks like they're still kind of running flat from where they were earlier this morning. Not too much movement kind of around the clock here in all of the market and all. Take a look now at the RH ecosystem. It's kind of flat right now. It's been having a pretty good couple of days though. And the great news here of what we're seeing is that now that there's a breakout in the Ethereum BTC pair, it's coming to benefit us here, and it's really benefiting us more than it would have before because a lot of the sell pressure is gone. You see, the sellers that have been pushing down the price, they don't have an infinite amount of these coins that they can sell down. Once they have sold their last coin, well, they're out and they can't hurt the price anymore. A lot of those guys are out. We're talking about the big dumb jerks that we all know by name, such as Jail Rat Crypto, Fat Pig, Green Hair, Brandon BB Me, and also Furry Boy, Furu Furry Finance, and Sergey Baranov. All those idiots are gone and they can't hurt the price chart anymore. So any positive price action that we have or any buy orders, they're going to have monumentally better price impact than any of the negativity and downward pressure we felt from past sell pressure, just because there's an absence of sell pressure right now. So finally, we got some good news. Now we got some not so great news. Well, it's kind of like 50-50. Here's what it is. It's 50-50. Yay, we get a rate cut. Okay, excellent. We like rate cuts. Haven't really done anything for the price, though. But also, we get a hawkish press conference, I bet. I'm fully expecting it to be a very hawkish press conference where Jerome is going to get up there and say, oh, yeah, we don't think we're going to do any more interest rate cuts, or we're going to have a very high standard for it. We're going to release a dot plot that everybody hates because all it does is it just shows that we're not going to do rate cuts. Now, of course, we just said for the past month that we weren't going to do another rate cut, or it wasn't a foregone conclusion and made you all panic sell and wreck your price charts and destroy your savings and investments. But then we backtracked on that. So we have a credibility problem here at the Fed. But forget about that for now. We just need you to know that, oh, we're going to put out a dot plot that is very hawkish, so you should be super bearish. And whatever you do when you're looking at your investments, do not do the following, which is something that Cairo Copeland is always telling you to do, or maybe not even him, but his little assistant, Margaret Qualley, is constantly telling you to do. You know what that is?
Control yourself!
Yep, that's the story today here. So let's take a look at this on CNBS. A Federal Reserve split over where its priorities should lie, lowered its key interest rate Wednesday, but signaled a tougher road ahead for further reductions, fulfilling expectations of a hawkish cut, moving the federal funds rate down to 3.5 to 3.75. All right, splendid. So that's moving down. I mean, we knew it was coming just because look at the 3-month T-bill. That was trading within the same range. However, the move carried caution flags about where policy is headed from here and featured no votes from 3 members, which hasn't happened since September 2019. Yes, let's see. Who were the no votes here? I bet Lisa Cook was probably one of them. Featured hawkish and dovish dissents. Stephen Mirren favored a half-point reduction. And let's see, Jeffrey Schmidt of Kansas City and Austin Goolsbee of Chicago. Okay, so that wasn't Lisa. Interesting. This was the 3rd consecutive no vote from Mirren, who leaves the Fed in January, and the 2nd straight from Schmidt. The previous 3 dissent meeting also featured a 2-to-1 divide from members conflicted between the need for tighter and looser monetary policy. All right. Post-meeting rate statement, repurposed language, meeting from a year ago. Well, I got to look at the year ago thing. If you don't remember, last year in the December meeting, times were really good in December 2024. It really felt like the bull market was happening. It was firing off all cylinders. Everything was going up. Absolutely everything was going up. It was incredible. I mean, this was also before like the Interpol candles. And the Pulse chain ecosystem was going off and doing very well. Ethereum was above $4,000. Bitcoin was above 100,000 and going higher. Sonic just came out and was doing pretty well. It was pumping pretty well. Or I think like the migration was going on, but still Phantom at that time. It was Phantom and it was doing very well. GameFi at the time was doing very well. Then came the December Fed meeting and it screwed it all up. It completely messed everything up and totally killed the bull market as we knew it, because since then, most altcoins just went down and stayed down or kept going down. Like, yeah, we had a new high in Solana the next month. We had a new high in XRP the next month. We had a new high in Binance a couple of months much later. We had some meme coins go off, which don't really count because they go off in bear markets. They go off in bull markets. It's not indicative of what kind of market that we're in when those things go off. But the majority of just about everything else had done nothing but gone down. When you look at the chart for the others, everything minus Bitcoin and Ethereum, and I think even if you included Ethereum in it, when you look at that chart, it's been straight down, pitiful, piss-poor slope ever since December 2024 and January 2025. But why is that? What's going on there? I mean, Sonic in particular had just been pushed down time and time again ever since that meeting. It got up to, I think, a total high of pretty close to $1. It was like 80-something cents. And then it just got kicked in the teeth and pushed down, even though it's great technology. I mean, I know technology doesn't really matter. Everybody thinks, oh, they got better technology than us over there. It doesn't matter. Sonic has got great technology, and it's been sucking ever since it comes out, yo. But why has that been the case? Well, it's because of what was being released at the time, which is what's being released right now, the dot plot, which is such a waste of time and energy. It's not worth the paper it's printed on. You shouldn't piss on it to put out a fire because of how worthless it is. But the dot plot basically tells you where the different governors on the federal, or the different members of the FOMC, where do they see interest rates going in the next year. And people take it just way too seriously, thinking it's carved in stone, when in fact it is not carved in stone. So let's have a look here at the statement and what it is that's changed in it. Available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, and unemployment rate has edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. I can just hear Jerome Powell's voice speaking about this here, as he reading this aloud here when he gives his presser in a little bit here. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges the downside risks to employment rose in recent months. In support of its goal, in light of the shift in the balance of risks, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.5 to 3 3/4%. In considering the extent of timing additional adjustments to the target rate for the federal funds rate, the committee will carefully assess incoming blah, blah, blah. The committee is strongly committed, blah, 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 blah. We don't care. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of the incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, blah, blah, blah. We don't care. So here's something that's new that they added this time around here. It says the committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term treasuries as needed to maintain ample supply of reserves on an ongoing basis. Now that right there, my friends, is money printing. It doesn't mean quantitative easing yet, and we don't really know if this is something to celebrate just yet here, because we don't know the extent of how much money printing they're actually going to do. Some say it's going to be 20 billion a month. Some say it's going to be 45 billion a month. We don't know just yet, and I think that's going to be one of those things where we got to give it a month to see how much they print in that month and then look back and draw our conclusions from that. Unless he talks about it in the presser today, which I don't expect him to. So voting for the monetary policy action were Jerome Powell, John C. Williams, Michael Barr, Michelle Bowman, Susan Collins, Lisa Cook, interesting, Philip Jefferson, Alberto Musalem, and Christopher Waller. Now, here's what's interesting to me here is like they're trying to get Lisa Cook off the board, but she's been voting the way that they want her to, that they want the board to vote. So it's possible that they may have really scared the piss out of her to just fall in line with the dubs on the board and not vote in a way that's going to piss off Trump. It's possible that that's the case here because, like, I'm sure they've got people following her everywhere they go. I'm sure they got the IRS combing through all of her tax returns and everything. It's like a police state for her. Voting against this action was Stephen Mirren, who pretended to lower the target range for the federal funds rate, or preferred to lower the federal funds rate by 0.5% at this point in the meeting, and Austin Goolsbee and Jeffrey Schmid, who preferred no change to the target range for the federal funds rate at this meeting. All right, so we got some good news and we got some bad news, because what we'll see probably coming up at the presser is much more hawkish language. Because I'll tell you, like the action that the reserve takes, the action that the FOMC takes, that's not anywhere near as important as the tone that Jerome Powell takes at the presser. And we're going to hear all about that when he steps up to speak, which is coming in about 8 minutes here. Now check this out. Where's the dollar index at today? It's been heading down, and this is a very nice move down. Take a look at the drop at the open right here. It's a then it bounces up and then goes right back down. It almost kind of looks like the Luna chart back when it had its collapse in 2022. And we're going to see a lot of volatility with this thing today for sure. So, this was above 99 earlier this morning, but then, day of the press conference, forces are now pushing it all down. What's the interest rate market here saying? Well, we take a look at the 10-year Treasury. It's come down, but only a tiny, tiny bit. It was at 4.18%. I think at a certain point today, it got up to 4.2%. Now it is down at 4.16. This is something that we want to watch here today. I do expect that these interest rates will go up because what causes these interest rates, particularly the 10-year Treasury, like what forces them up or forces them down? What is the decision making that goes into what price it's at? Is not so much supply. I mean, that does play a role later, but it's not the immediate role plays. What goes into this here, though, is the growth and inflation outlook. And we're going to have a much different growth and inflation outlook probably after we hear from the presser. Take a look at the market here one more time before we go to the presser. Bitcoin is still climbing. It's because Jerome Powell hasn't spoken yet. Probably when he speaks, we may see some different price action. Of course, I don't know. I mean, it could be something where he doesn't get asked a dumb question that has him go off on a tangent that's all hawkish and everything, because that's what happened last time. But we'll see about that. Little bit of housekeeping here. If you want a copy of this book for free, I will give it to you for free. It's called Your Parents Were Wrong. Debunking and Replacing Outdated Advice. What were your parents wrong about? Well, your parents probably told you that it was a good idea to go to college or get a good corporate job, a good white-collar career working in corporate America with a stable income. And they didn't tell you that, yeah, college is probably a waste of money unless you're going to study something worthwhile. You probably should learn a trade or some other kind of rare skill. They probably should have told you, but didn't, that white-collar corporate America really sucks. You're barely doing any work. You're sitting in meetings that could have been emails. You're sitting in sexual harassment seminars being treated like a criminal that's guilty until proven innocent because, oh my God, there's some disgruntled female that lodged a complaint against the company, and now all these lawyers marched in on a parade and made life a living hell for everybody else there. So you need this book to tell you why your parents were wrong, and I'll give it to you for free. All you got to do is head on over to my Substack. That is reinventideal.substack.com. I repeat, reinventideal.substack.com. Just published a new one not too long ago. And click right here where it says free gift. And once you're here where it says free gift, just come over here where it says subscribe and subscribe to my Substack, and you will get a copy of this book for free emailed to you, sent right to your email. All right. It says I don't think my mic is on. Yeah, let me try to fix that. Oh, you guys are right. Yeah, I'm on the crappy mic, so it should be better now. How about there, guys? Does that sound better? All right. It should be better. Crypto Durgans has got a question. I see your question there. Don't worry. I will answer it. Before we do, though, let me check. Is the presser started here yet? Not quite, but it is coming. We're about 4 minutes away. Next thing we want to talk about here is when money printer is coming. When is it coming? I know that's one of y'all's questions, but check this out here. Don't know if I can play it just because of like copyrights and everything from YouTube that is policing and making us all look like a bunch of making us all act like a bunch of paranoid schizophrenics here. We can't play anything without getting copyright strikes and demonetized or having our account nuked. But Jeff Gunlack, who is from founded Double Line Capital, so he's a very important guy in the bond world. He ran the TCW Total Return Bond Fund. He says that when the 10-year Treasury reaches 6%, that's when he thinks the Fed will announce QE like we've seen before, where they start buying back the long-term bonds. Right now they're talking about buying T-bills, which are short-term bonds, but he thinks at 6%, that's when you'll see that the Fed will just have to step in and start buying the long-term bonds, which is QE like we've seen before.
And when you do that, you will have to be very quick and buy as much as you possibly could. Just like when they announced buying corporate bonds during the pandemic, bonds ripped. So he's just talking about bonds. But here's the deal. When this happens, it's not just bullish for bonds, it's bullish for everything, especially risk-on assets. Because, for one thing now, like bonds and stocks are totally correlated. Like the new offset, where the new balancing investment for stocks is it's not bonds anymore. It's gold. And you want to have something stable in your portfolio. When you want to have something that is offsetting the risk that you're taking in stocks, what a lot of people are doing is they're using gold for that. They're no longer using bonds, which makes total sense to me. Now, here's what else I think, and what a lot of other people, such as Stephanie Palmboy, they think that Gundlach is only saying 6% because he really wants to say 5%. But he doesn't want to say, yeah, it'll happen at 5%, and it doesn't happen, because maybe the Fed's going to wait for like 5.35 or 5.25 or whatever. But we all kind of think that, hey, it's going to be 5%, especially if Kevin Hassett is the chairman at the Fed, or somebody else that, Trump gets another seat on the Fed, then that's another thing. It could happen. And I got a story that I'll probably share with you on this stream here about the possibility of them actually winning their case at the Supreme Court against Lisa Cook so that they can get another seat on the Fed Board of Governors. And if that happens, well, yeah, then it is money printer time. And that's when I can finally do the stream where I talk so much trash and call out so many people and tell people that, hey, yes, the bull market has officially started. And man, when I'm doing that stream, make sure you kids ain't listening, because I will be cussing more than I've ever cussed in my entire life. I will be calling certain people out by name, and I will be destroying and ending their careers in this industry or this niche or whatever you want to call it here. It looks like the presser is starting. You guys let me know if you can hear it or if you can't hear it. I'm going to try to make it a little bit bigger here. There's no sound going on right now because Jerome Powell hasn't walked out yet. But when he does start speaking, here he comes. All right, let me know if you can hear it or not hear it.
Good afternoon.
Always starts with that.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand.
Because the top 10%
in contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline.
While he's talking, let me also tell you this right here. Bitcoin is continuing to rise. It is now up to 92,840. It could be hitting 93,000.
The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier.
Bitcoin, by the way, has crossed 93,000. It is now at 93,100
in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5% to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate.
And here's the problem right here. The dot plot, this is what messed us up last year, is this piece of crap.
Under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the
Money printer, not the one we want just yet, but I fired it up here at least.
sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter,
That's what we wanted to hear, was how much we're going to do per month. So 40 billion in the first month, that's twice than what we thought we were going to get.
we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, I'm sure you do.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and
that just sent Bitcoin back below 93,000.
The balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
Good question. I like
So
this.
a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up; it's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is. The implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions.
Of course, she's looking for drama. Like, you're trying to there to be drama where there isn't any. Like, there's no drama here.
And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmerosa, The Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that.
It's much more dovish than I expected, right there. As he's basically saying, yeah, we don't really think about a rate hike at this point. Rate pause is still equally hawkish, though.
What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see
Bitcoin is rising back up. It really likes what it's hearing at this point.
any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Claire Jones, Financial Times. Why did the committee decide to move today instead of moving in January? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's going to come in a touch lower, and I think the evidence is kind of growing that what's happening.
Bitcoin is back above 93,000.
Here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious.
I bet he says absolutely nothing about it.
Why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a
What did I tell you?
mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this, and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Like,
You can tell right away he did not like that question. See, the thing about Powell is when he gets a question he doesn't like, he answers it very quickly so he can move on to the next question.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break even.
Thank you. The clown that asked this question apparently doesn't understand how bond yields are formed, particularly with a 10-year treasury. It's not based off of the federal funds rate, you moron. It's based off of growth and inflation outlook.
And they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money. And we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%? Because
the dollar index keeps going down. It's at 98.7 right now.
inflation is relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Because the official data is bull crap. If you understand how they take it with the whole unemployment rate, you'd realize, this doesn't give you the full picture.
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be, but for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's
I'll tell you guys what, man. I think 3 years from now, this isn't going to be a story anymore about AI is going to take our jobs. That won't be a story 3 years from now. I'll talk about that after the presser.
It may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, this could put a lot of people out of work. What are they going to do? In the past, there's always
really
been
rising
more
on
work
this
and higher
here, guys.
productivity.
Really rising, almost at 94,000. I think Ethereum is liking this too. It is above 3,400.
And incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
There's no point in asking him a tough question or asking him about, well, what if this happens? What if that happens? Because you know what he's going to say. Well, we'll depend on things. We're dependent on the data.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called
Bitcoin is back above 94,000.
K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So, it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that
DXY is tumbling as well.
ended with the outbreak of the pandemic. We saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem. And really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, a secular housing shortage, a structural housing shortage.
Bitcoin is very comfortably above $94,000, and the stocks are loving what Jerome here is saying.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
I'm about to ask him what he's going to stay on as a governor. Jeez.
See, my thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what and it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again,
will you stay as a governor or will you go?
I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Damn it.
Go to Mark for the.
Was really hoping he'd say, "Oh God, I hate this job. I don't want to be here no more. So after my term ends, I am out of here, not even fulfilling my term as governor. Screw this place. You guys can have the whole burning thing."
Last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints insufficient?
Bitcoin is going back down. It's getting close to 93,000.
Sufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
And away he goes. All right. So now we must see what is the reaction from the markets to everything that was just said. So let's see. We're going to go over to this window right here and have a look. Bitcoin is comfortably above 93,000 and rising. It was up above 94,000. Hopefully it can get right back there. So I'm hoping that it does. It's officially turned positive on the year, so we might actually end up with a positive 2025 for Bitcoin. Still totally negative for most altcoins, as you can kind of see over here on the far right column. You see this right here? Like Solana had been like the darling of this cycle. It's down 25%. Cardano down 44%. Let's see. Sui, that's got a whole bunch of love this entire cycle, and it's down 59%. Athena, Ondo. I mean, these are good projects right here. I've basically selected the projects that I think are the most investable in my watch list here on CoinMarketCap. All right, we are going right back up, 93,600. Ethereum is actually impressing me for once in its pathetic life. It is staying above 3,400. Now, what could be the reason for this? Like, why are we responding positively this time when every single one of these pressers that we've had where there was a rate cut, there was negative price action afterwards? Why is it reacting so favorably this time? Is it because of the money printer that got announced finally today? Is that the catalyst that is going to actually start the bull market? Are we back in business here, guys? What am I thinking? Woo! Woo! That was one of the best announcements that we have been hoping for, that not only are they turning on the money printer, but they are going to be printing more money than we expected. Everybody was expecting just $20 billion. They are doing double that. They are doing $40 billion a month. So not $20 billion a month, but $40 billion a month. What do we got to say about that? Woo! And what's that going to do to all of our coins in the market?
It's all coming back.
That's right. They will all start coming back. Now, don't get excited just yet. Don't get too excited just yet.
Control yourself!
You need to do that first here, because yes, this is money printing. Yes, this is good news. But a couple of caveats here. One, the purchasing doesn't start for a whole nother 2 days. Matter of fact, let's take a look at the Fed balance sheet. Where's that at right here? So it hasn't been updated yet. It's always a week behind. But if we take a look at the Fed balance sheet, it got all the way down to $6.535 trillion. They really ramped up the maturities here. I mean, they didn't physically make this happen. They didn't force this. It's just there were more maturities coming due this past week than previous ones. But even into December, they still were doing quantitative tightening, even though they said they were going to stop it. They kept it going for a little bit longer. That's all right, though. We're okay with that because that gives them more room to work with when it comes to turning the money printer back on. And now as they turn that money printer back on, doing, $40 billion a month. Let me just get my math here right. So let's see, $40 billion a month. That is going to be 480, almost $500 billion over the course of a year. So about $500 billion will be printed and added to the economy throughout the course of next year if they don't ramp up the pace, which they really could ramp up the pace. And going by the logic that say like 6% of that money, just 6% of that money ends up in crypto, what does that mean for us? About $28.8 billion on the year is going to be added to crypto. And you might think, oh, that's just not that much because, the crypto market's so much bigger than that. Let's have a look here at it. The crypto market is $3.4 trillion. That's what you're going to hear. Right? Guys, the market cap is not what you think it is. All right? When we add 28 billion to the market, that doesn't mean market cap is going to go from 3.2 trillion to 3.48 trillion just off of that. That's not how it works. You see, where it's really going to go first is it's going to go into here, the trading volume. Instead of 140 billion, well, that will now be a lot higher. It will be, let's see, what is that? Like what, 58, I'm sorry, 15% higher, right? 20% higher. So the trading volume be 20% higher, and it's positive trading going in. That is going to push this market cap up higher because the increases are not linear increases, they are exponential increases, particularly in altcoins because their liquidity is so low. And what altcoin ecosystem has the absolute lowest liquidity of all crypto ecosystems out there? This one right here. As a matter of fact, the coin that has the lowest liquidity, probably of all of them, is this one right here, the incentive token. And looky here, it's doing just fine. Still kind of flat across the board here in the entire ecosystem. It will be going up probably in the next couple of days. Now, I'm still saying don't get excited. I mean, yes, it's great that we're having some good things happen to us monetary policy wise for once in this whole year. Yeah, that's great. And there's a lot more good that can still happen, but we got to bear a couple of more things in mind here. I still say throughout the rest of this year, 2025 or Q4, the rest of December is going to suck. So before you get too excited and take your big stack of stable coins that you've been saving up and blowing it all into the market, before you do that,
Control yourself!
I still think the rest of December is going to suck. And why do I think the rest of December is going to suck?
A legitimate question, young man, deserving a legitimate answer. Now then.
Because we still have some risks going on in the market that have not been fully dealt with yet. The main one that I have been ringing the alarm bells about for the past few weeks is this one, the carry trade with the Japanese yen and the Japanese bonds, because my girl, Sanae Takeshi, in Japan is doing massive stimulus spending out there, which had been weakening the yen. And because it had been weakening the yen, or it had been causing inflation out there, as they're trying to fight inflation by printing more money. And because of that, they're having to issue a lot more of those Japanese government bonds. And those Japanese government bonds, because there's so many in supply without an increase in demand, the yields on them are going up as their prices are going down. And when those yields go up to a high enough point, the Japanese stop investing in foreign markets like they do now and start investing domestically. So they will sell their foreign investments, which could be our stock market here in the United States, crypto for sure, and definitely U.S. Treasuries, because they're the largest foreign holder of U.S. Treasuries. They sell that, and then they go invest in the Japanese government bonds. Also, the carry trade, where you borrow money from Japan to come invest in higher yielding investments here in the United States or anywhere else in the world, that trade is threatened when interest rates in Japan go up. Interest rates in Japan will go up coming up December 19th when the Bank of Japan, which is their version of the Federal Reserve, has their meeting, and they decide that they will raise interest rates by 25 basis points. So they did the opposite of what we did today. And this here, you can already see it over on, like if you got Bloomberg Terminal, what you want to look at is the overnight index swaps, which you can see here. And what it says is that 2 rate hikes are priced in for the next 10 months. As I say, well, by October 2026, they expect there to be a total of 2 rate hikes to take place from the Bank of Japan. Is this a problem for the crypto market for the rest of the year? It could be. Is it going to lead to a total disaster or a great big sell down where we're looking at $40,000 Bitcoin, where we're looking at $800 Ethereum? I mean, it could happen. I think it's less likely now than I had been raising the alarm bells about before. I don't know that it goes all the way through to that level because, you see, here's the deal. The reason why I'm less worried about it now is because everybody is paying attention to it now. You'll notice everybody now is finally talking about it, even though I was talking about it long before all of them weeks ago. Now they apparently finally got their heads out of their butts, because that's where their heads were. It was like stuck so far up their butt to notice, oh, hey, there's this guy over on Reinvent Ideal who is telling everybody, hey, you should worry about the Japanese carry trade. And they were like, oh, I'd be worried about that. Because, if you're Ivan on tech, what are you doing? You're going, Perfectors! I don't understand. Why is your coin down? Oh my gosh, it's all this Fugazi. Oh, yes. We're pushing the button. That's how Ivan on Textbox. Or if you're George from Cryptos R Us, you're going, welcome back to Cryptos R Us. I'm George, and I'm constipated. And we're all constipated. Or if you're Wendy O, you're starting every day going, welcome to the O Show, everything crypto and NFTs. Oh, wait, I don't say NFTs anymore because NFTs turned out to be a scam, and I should have known that because Richard Hart told me that, and I ignored him. But anyways, we were in a super cycle. She doesn't say that anymore either. She doesn't say we're in a super cycle. She was saying that for a while. Oh, yes, we are in a super cycle. But then throughout all of 2025, the super cycle didn't happen. So now she doesn't say that. Gee, was there somebody you could have listened to instead that was giving you real information, that was telling you the truth throughout the entire year? And had you listened to him, not only would you have saved money, but you would have made money? Why, yes, there was somebody you could have listened to. I forget what his name was, but it was like some sort of Egyptian-sounding name. Yeah, who knows? But the carry trade is still in play, and it could be a problem. After December 19th, we'll know more if it's going to be a problem. I am not comfortable just yet giving you guys the all clear, nothing to worry about, bull market has begun. I'm not comfortable giving you that yet until we get past the BOJ's meeting, because a lot can still happen between now and then. I mean, that's not a week away. That's, 10 days away? Yeah, it's on the 19th. So that's next Friday. Still got to hold our breath for that. I'm still continuing to stack stables until then. But we'll have a much better idea of what's going to happen with that trade after that meeting has occurred and after the market has had time to absorb it. So probably the following week, which would be Monday 22nd, Christmas week, that week there, we're going to know a lot more about whether the carry trade is a problem that we should worry about. And if, we get through that here and we have a nice Christmas week, maybe that little Santa Claus rally where Bitcoin goes positive on the year, well, in that case, what we're probably going to be doing into the new year is this. Woo! I'm sure hope that that's what we end up doing, but I don't want to give you that guarantee yet. I don't want to make that call just yet. But this is very nice to see that Bitcoin is finally doing something positive here after a Fed meeting when it was supposedly a hawkish rate cut. Pulse chain ecosystem still kind of flat. That's all right. Incentive token's doing all right, though. Let's take a look at everything else here. I mean, the whole time that Powell was speaking, the stock market was loving it. Absolutely loving it. Looks like we got some new stories popping up right here. I'm going to just refresh. And what's the story? Trump says Fed could have at least doubled latest interest rate cuts. Well, of course, you'd say that. And that's what Stephen Mirren was saying. Ooh, here's an interesting story. Trump says U.S. seized oil tanker off the coast of Venezuela. Didn't want to cover this here just yet, or didn't want to talk about it just yet, but I do think that there's a war or some kind of potential military action coming between the United States and Venezuela. I'll save that for another stream, though. But let's take a quick peek at this story here. Escalated pressure on Nicolas Maduro in recent weeks, saying his days are numbered. Most of Venezuela's exports go to China. It is all about oil more so than it is about drugs. But yeah, we'll save that for another stream. Here's the story that really is related to what we were talking about today here, and that is the final Fed chair interviews. I mean, I heard that he had his decision made already. So these interviews are probably just kind of a ceremonial processional, just something that is done out of like obligation because, oh, we have to, just like, you ever had a job open up at your company and human resources interviews you and you give the best interview you possibly can, but they hire someone else that they had in mind all along and everything was just going through the motions? That's kind of probably what this is here. This is the only thing I don't like about this story. They don't want Kevin Warsh. Kevin Warsh sucks. He really sucks. Kevin Warsh, man, why can't you just withdraw your name from consideration? Because Kevin Warsh is a hawk, and he will never turn that money printer on. I mean, just take a look at these two right here, all right? I mean, take a look at these two guys, and you want somebody who's going to do a good job for you. Which of these two would you hire? And some of you people might say, well, I want to go with this guy over here. He's better looking. No, you do not want the better looking guy. You want the goofier looking guy. Because I'll tell you 100%, the goofier looking the guy, the better he is at his job because he has to be. I know this for a fact. I have lived this my life, folks. I've lived this all throughout my life in every career that I ever had. Was I the best looking financial advisor? No. There were plenty of other better looking financial advisors, and they got promoted all the darn time just because they were good looking. They were incredibly stupid. Really stupid people got promoted in financial advice, all because they were good looking, and people would bring them money. They would win clients all the time, all because they were good looking. But guys like me that weren't blessed with the good genetics, well, we had to work twice as hard to be twice as good so that we could compete with them. Going back to my older career, when I was a stripper, I wasn't the best looking guy either, so I had to be really good at dancing. I had to be really good on the pole because that was the only way I was going to draw attention from the tall, good-looking strippers. So the goofier looking the guy, the better he is at his job. That's why we want Hassett. He's an asset. We don't want Warsh. He'll make things worse. If I was campaigning, if there were campaigns, all right, if I was campaign manager for Kevin Hassett, that'd be my slogan. All right, so hopefully the announcement that it is Kevin Hassett comes through sooner rather than later, and that way these pressers with Jerome Powell become less relevant. Jerome Powell becomes less relevant, and hopefully that makes him so dissatisfied with his job that when his term ends in May, he not only resigns or steps down as chairman, but he also resigns as a governor as well. Hopefully that's the case. How did the DXY react here to that presser? Well, favorably, because it is going down. It's down to 98.64, and it could be going down a little bit more here. I would expect to see this probably at 97, or close to 97 before the end of the year, because it's already estimating the addition of $40 billion a month to the U.S. economy. All right, because USM2, if it's already at a new high, it just basically got back to where it was before the Great Contraction. But now that it's back at the peak that it was before the contraction, it's back to where it was at like the height of 2021. Well, now anything added, it really is icing on the cake. And hopefully the additions just keep going higher and higher. Let's check the market one more time here. Let's refresh. Still at 93,600. Ethereum kind of dipped below 3,400, but that's okay. It's only $3 below, so we're not worried about a decline here yet. Rest of the alts, they aren't really showing us anything, but that's all right. So DXY coming down. Now, some other stories I wanted to show you here today. Man, let's go ahead and play this here because I think that this is something really important to discuss. Let me start it from the beginning. Oh, wait a minute. Wait a minute. You guys won't be able to hear it, so give me just a second and move it over here so that you can hear it. And I see all you guys' questions. I will answer them. Don't worry. See, how do I do this again? Oh, yeah, I got to do this and do this. Okay.
Are we seeing that priced in, or is there still a reckoning to come?
Well, let me play it back from the beginning here.
And I want to start there, considering the fact that you've talked about how the U.S. is going to go bankrupt.
Oh, wait. I'm not on it. Sorry, guys. Hang on. The sound's still not going, is it? Let me fix this here. I close this one out, and then I put it in the other one. Sorry, you guys. I'm not a professional YouTuber, and I don't claim to be. Okay.
And how it's on an unsustainable.
Play it from the beginning, and
I want to start there, considering the fact that you've talked about how the U.S. is going to go bankrupt and how it's on an unsustainable fiscal path. Are we seeing that priced in, or is there still a reckoning to come?
Well, it's certainly behaving differently than it was for the last 4 decades. I mean, what we've seen is in the last 15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up.
Yeah, there is a negative correlation between the dollar index and risk on assets. There was some guy, man, nobody really remembers his name, but there was some guy that tried telling me that that doesn't happen. We're seeing it happen live right now, but he actually had the audacity to tell me that I didn't know when I said that. And that is why no one remembers his name.
This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently. Usually when the Fed starts cutting interest rates across the yield curve go down. The 10-year Treasury almost always goes up immediately following the first Fed rate cut, and then it keeps rallying for a while. This time, the 10-year yield went up, and the yield curve is steepening. So I think what we have is a recognition that the interest expense for the United States is untenable if we continue running a $2.1 trillion budget deficit and we continue to have sticky interest rates.
So what he's getting at here is that even though they're trying to bring down the interest rates for the national debt, they are not succeeding at doing that because every time that they cut the interest rates, the 10-year Treasury yield is going up. Now, the 10-year Treasury yield is not set by the federal funds rate. It has no relation to it. I mean, there's some relation, but very little. Because what sets the 10-year Treasury yield is the growth and inflation outlook. As more debt is being issued, and as the deficit grows wider, as more Treasury bonds are being put out there, or Treasury bills like right now, that is going to increase inflation. Hopefully that increases growth too, that all the money that you're extracting out of the U.S. economy, you're sending back to the U.S. economy. Hopefully that happens. The 10-year Treasury is pricing that in, and that's why the yield is growing. And what Jeffrey here is saying is that, well, since it's making interest expense on the national debt more expensive, they can't let that go on forever. The Fed may have to step in and do quantitative easing, which he says right here, I believe.
One thing that people fail to appreciate is how much the average Treasury payment has gone up. The average yield, the average coupon on Treasuries was below 2%. The entire Treasury market, all 30-odd billion of it, you average it all together. Some of them are old, they were issued with higher interest rates, but it was below 2%. Now it's pushing 4%. And as long as bonds are maturing, and there's trillions and trillions of dollars of them maturing, a lot of them were issued back in, 2009, 2008, these other time periods, even if you just issued them in 2019, some of these are starting to come due. And they were issued with coupons of 0.25%. And now it's 4.25%. So it's 400 basis points higher. So this problem continues to build. And there's an awareness now that the long-term treasury bond is not a legitimate flight to quality asset. It's not responding.
As I was saying earlier, is that no longer are they using bonds to offset the risk in stocks. Instead, they're using gold. That is making the yields on these treasuries go higher.
To lower interest rates. It's not really responding to an inflation rate, which is now 2.5%. Probably going to go higher on the inflation rate because the ones that are rolling off from a year ago, I mean, the cumulative, I think, headline CPI that came out today, it was a 0.18, but the one that was rolling off, I think, was 0.1. And if you do the next 2 months, those 3 months together, that quarter, the cumulative rise from a year ago was 0.1. So we're likely seeing the low point in near-term inflation. So yeah, I think the reckoning is coming, is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually...
You could turn on the money printer, and that's how you deal with it.
We're going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005. And there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position. And the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so...
And he's talking about foreign investment in the United States, but also foreigners investing in U.S. treasuries. And when the foreigners are investing in those U.S. treasuries and are going out, they're going to sell those treasuries, which will push their yields up.
So this is a moment where finally you have the setup where non-U.S. investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the US.
Trillion.
Right, exactly.
Yeah.
Whatever it is,
Yeah.
3 trillion. You're getting trillions of dollars moving out of U.S. assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking
shorting
about
it?
this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot because there's going to be a response. And I've got...
Talking about like the Fed taking action to do yield curve control.
Many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing on buying long-term treasuries. And
that's what we want to see happen.
And they do. You have to very quickly, and hopefully you do it the day before they announce it.
Then you talk about how to invest in bonds when that happens there. So that was that story there. Oh, we got some action going on in the market here. Let's get back to looking at the market, apparently Bitcoin is giving back some gains, and it's back to being negative on the year. Yeah, just oscillating back and forth between, the highest it got a couple of days ago was 94,000. Now it's probably working its way back down to 92,000. Yeah, I think it's just absorbing the information. Maybe they're making too big of a deal of the dot plot that came out, because that's what they did last year, is they looked at the dot plot and they took it way too seriously, like it was set in stone, and decided to just completely wreck the market and cancel the bull run from that point on, all because of that. Yeah, there was other things that stopped the bull market at the time. But as I was saying here, guys, don't get too excited yet. I don't want to give you the all clear, and here's why. You see it happening here in real time, that we still have a difficult time ahead of us. We still have the remainder of Q4 to get through, and Q4 is just going to suck no matter what. Not just because of the carry trade that I talked about earlier, but also you have people that are doing tax loss harvesting, which is perfectly all right to do that. I did some last year, I did some this year. But also, in addition to tax loss harvesting, there's some people that are 4-year fundamentalists that think it's all over, and they're selling now too. And come at the turn of the year, it's still going to be going down a little bit, because then you're going to have the few people that are in profit that will sell and realize those profits, because now they have a whole new tax year to prepare for, and they don't have to pay the taxes on it until 2027. So it's all right. I mean, we still got a long time ahead of, I don't want to say a long time. We still got probably at least 2-3 months of sideways price action, or maybe even some pain. But then what happens is, when 2026 really gets going, what's going to happen then is people will be getting their tax returns and getting a lot more than they expected. Because remember, there's lots of tax breaks in the big, beautiful bill, lots of stimulus that is going to be going out to people in the form of their tax refunds. And when that finally gets going, people have money again. What are they going to do with some of that excess money? Well, they will spend it in the economy for sure. There'll be lots of spending going on, but that's good, because that's going to create jobs, because you get the economy going again. And when it creates jobs and people start getting good paychecks, what can they do? They can start saving money again. Because you see, here was the problem throughout all of 2025. Why was it a sucky year? Because the economy was bad. You see, in order for people to buy these coins, I mean, if you want to have a bull run, people have to buy the coins, right? We all agree on that. Okay, so they buy the coins. What money do they buy it with? In order for people to buy the coins, they got to have jobs. In order for them to have jobs, the economy has to be good. The economy is not good. Job situation sucks. People don't have incomes. And their money's being pissed away on stupid stuff because the price of everything just keeps going up. That's the story. I was going to talk about this here. Bond investors warn Treasury over Hassett as Fed chair. Scott Bessent knows what he's getting into with telling Trump that they should have Hassett. He knows what he's doing. So if I was Scott Bessent, I would tell those bond investors to go F themselves. All right? Seriously, I have zero respect for bond investors or anybody that goes into fixed income. And I got zero respect for all those dumb boomers. I can't wait. Trying to be nice here, not say what I really think, but I have zero respect for all you dumb boomers that just go, I want a fixed income. You all constantly complain about how your life sucks, even though you made it suck that way. And when anybody wants to go have any fun, you always say, I want a fixed income. Okay, well, why don't you just enjoy the rest of your miserable couple of years left on this earth on your fixed income? So, bond investors don't like the idea of Hassett. That's how you know it's good, though. They should love Hassett, because if he turns the money printer back on, that is bullish for everything, including your piece of trash bonds. All right. Next thing here, next story I wanted to talk about was, what does Lynn Alden say about what was announced today? Lynn Olden is somebody you should be following if you haven't been following. She says it is the gradual print. Here's what's likely to happen from the announcement today of $40 billion a month. Yeah, it's not what we saw in 2020 where they just added trillions all within a month, but it is still something that's very bullish. It is money printing that is good for the crypto market. I mean, what everybody really wants, everybody is really hoping will come back is something like this. I mean, we would have to have a disaster like the carry trade unwind to cause something like this here, guys. But instead, what we're going to have is a gradual liftoff like we had over here, 2010 to 2011. And a gradual print like that. I mean, would you be happier if it was a gradual rise up instead of something that goes up real fast and it overshoots and then a bunch of panicky imbeciles come in and sell it down? Because that's what happens every time. The faster it goes up higher, the quicker it gets sold right back down because a bunch of panicky idiot holders go to the top and then they sell. So we have a gradual print ahead of us where we can grind up, hopefully for the next 3 years. Maybe it gets all done within this year, but I'm hoping that it's just a climb up and up and up for the next 3 years. And I do foresee ways in which that can happen. Now, going off of what we just talked about here is that the interest on the national debt has done nothing but grown and grown and grown and grown. This has to get fixed. And the only way to fix it is with the money printer. It's the only way we do it because the U.S. government now spends more money on interest than it does on national defense. It's not sustainable. This is how you know they may have to ramp up the money printing because interest on the national debt keeps growing. That was something that Lynn Alden was pointing out here. Let's see. Reserve will start buying treasury bills. Let's see, did they update this story here? Not lately. Okay. So Federal Reserve on Wednesday said it would start buying short-dated government bonds to help manage market liquidity levels to ensure central banks retain firm control over its interest rate target system. It's a little bit too complicated to talk about how that works here. We'll probably save that for another stream. But effectively, the money printer will be turned back on December 12th. This, by the way, is, I wanted to show you this earlier here. This is why Pulse Chain had a good couple of days, is because of this. The Ethereum Bitcoin ratio has broken out of a major resistance line. Let's hope that this continues. Here's another thing of why the money printer is probably going to have to get ramped up. I mean, going from $40 billion a month, I think they're going to have to raise it all the way up to $100 billion a month, maybe even higher, because look at the year 2026 and how much U.S. Treasury bonds and Treasury notes come due. About $9 trillion, almost $10 trillion. Do they want to refinance that debt at 4% interest rates and make interest expense go all the way up to greater than Social Security? No, they don't. So that's why they want to put Hassett in there to turn on the money printer to buy up these bonds that have to be rolled over and refinanced. And if they don't, if they refinance them at the current rates, they refinance these at somewhere between 3.5 to 4.5%, interest expense on the national debt's just going to keep growing and having them issue more bonds. And then the next year, they're going to have this same problem over again. Because here's the thing. If they don't get lower rates on a 10-year bond, they're going to refinance this $9 trillion at T-bill rates. And those T-bill rates, yeah, they'll be lower. They'll be like 3.5 to 4% or so. But they're going to come due the next year. And you have another maturity wall in 2027. I think they want to get this taken care of before 2027. I think I want to get it taken care of before the midterms. That's why they really want to get Lisa Cook off the board. This I'll probably talk about the next stream here, but and this one I probably did talk about next stream as well because it's a little bit of a messy matter. And let's see. I wanted to also point this out from Lynn Alden. In the presser, Powell suggests 20 to 25 billion monthly balance sheet expansion is new baseline for ample reserves, and they are doing 40 billion currently to deal with liquidity issues and to get ahead of April tax day liquidity drain. Now, this is all just dressing language here when they say, oh, we're doing it for this reason. They're trying to hide the fact that they are doing quantitative easing. They're trying to hide the fact that they're printing money. And so they're coming up with a whole bunch of crap here to say, oh, we're doing it because of this. We're doing it because of that. When I guarantee you, well, I shouldn't say guarantee. There ain't no guarantees. But I highly suspect that come April 15th, tax day 2026, they will be announcing that they'll be doing even a larger amount of money printing. It will be, instead of 40 billion, it'll be at least 50 billion around then. I am pretty sure that that is going to be the case when that happens. Now, this here, I want to cover here because they did mention it in the presser. Somebody asked a question, which, of course, Jerome Powell is not going to answer. And here's what it was, is that we have some positive rays of light heading our way with the Lisa Cook situation because the Supreme Court seems to be going Trump's way on a similar situation where they're trying to fire a department head, and that was the FTC, the Federal Trade Commission. They were trying to get rid of Rebecca Slaughter. Before we get into this, though, let's check the market. Bitcoin is down a little bit more. I think it fell below 92,000. Now it's back at 92,000. Looks like it'll be coming down a little bit more. Man, Ethereum is really holding its ground here against it, though. So it's down in 91,000. Is this the water receding before the tidal wave? Or is this going to be a slow grind down until the BOJ has their meeting next Friday, where we may have a huge grind down? Now, bear in mind, if we do get like that complete upsetting, distressing, price gets chopped in half action from the carry trade failing, bear in mind, something like that is going to cause the Federal Reserve to have an emergency meeting, and you'll know it's an emergency meeting because they'll be doing it on Christmas Eve or Christmas, and they'll be doing it because not only is crypto going to be down, but the stock market is going to be down too. Like you see the S&P 500 lose 30%. Well, that's where they bring out the Fed put, or what they call the Fed put, and that just means markets have seen them do it so many times before that they believe the Fed will do it every time, that whenever there's a huge disaster, they don't let it stand. They don't let it stay. That's okay, this huge disaster, let's just sit here and take it up the butt. Let's let all the bears put their strap-ons and really give it to us right there. They don't let that happen. No, they don't. What they do is they turn on the money printers, or they do an aggressive interest rate reduction to stop all of that bearish action. All right, but anyways, back to this story here. What I was wanting to say here about this, they were up against the Solicitor General, or they were questioning the Solicitor General, U.S. Solicitor General John Sawyer, at the Supreme Court. And the questions that were asked, particularly by Supreme Court Justice Kavanaugh, were very telling, or giving us a lot of thought about the upcoming Lisa Cook case, which will take place on January 21st, 2026. It was a question that he asked specifically, and they're ruling in favor of Trump that he has the authority to fire people that are unelected department heads. So the Federal Trade Commission is one of them. He wanted to fire Slaughter, and the Supreme Court is voting in favor of him being able to do that. But here's the real interesting part, is that Justice Kavanaugh expressed concern to Sawyer about threatening the independence of the Federal Reserve. He asked, how would you distinguish the Federal Reserve from agencies such as the Federal Trade Commission? And I don't know if they put his answer in here. Not so sure that, I don't think they put it in here. But we know what that question is all about. That is Kavanaugh thinking about how he's going to rule, or getting more information to think about how he's going to rule in that Supreme Court case to remove Lisa Cook, to see if that can happen. And the reason why that's so important there is that if she can be fired, well, then that means that Trump can name more governors to the Fed's Board of Governors that are like Stephen Mirren, that are like Kevin Hassett, and want to turn the money printer back on. Kavanaugh is one justice that we don't know how he's going to vote, because you kind of expect him to be down the line for Trump, because, man, Trump went through a lot of trouble getting Kavanaugh confirmed. But the only ones that we can really rely on to be Alito and Clarence Thomas and Gorsuch. Those are the only ones that we know for sure are going to vote in favor of firing Lisa Cook. The three liberal justices like Jackson and I think it's Sotomayor, and is Kagan still on there? I think Kagan still is. We know they're going to vote against it, because they're just Democrats that want to vote against anything a Republican does. The ones that we're not sure about, John Roberts is another one. We don't know how he's going to vote. He can go either way. He's as bisexual as they come when it comes to these rulings here. Man, and I really mean that he's bisexual in the sense that, like, sometimes he does the right thing, and then sometimes he bends over and takes it up the butt from the liberals. So we'll see how that plays out in this case here. I forget what the ninth justice is. I forget who the ninth justice is, but they're another one where they're very hard to predict, and how they're going to rule is highly in question. Now, another thing that we should check on here is Fed net liquidity. The latest reading that we've got on it, though, is it's 10 days old here. It's November 30th, and so far, it's still very low. So for us to be where we're at right now with very low Fed net liquidity is incredible. We should be very grateful that we are not down in the 40,000s on Bitcoin, because according to this, we should be, because the liquidity, Fed net liquidity is very low. Something else to point out here is that in the Treasury General account over here on Fred, it's being replenished. So even the bit that they had spent and spent down, it was about $40 billion. They almost reaccumulated it all, because now it's at about $35 billion greater than it was before. So there's still a ton of money yet to be unleashed in this economy. Still a lot left to spend and stimulate the economy with. Now, let's have a look here at our questions. Let's see, you guys been submitting some questions here all throughout the stream. Let me answer them for you. First one comes from Daniel Liu. He says, yo, is it moon time now? Fed wants to buy Treasury bills! Yell it because you typed it all in caps here, so I guess you're yelling at me. But is it moon time yet? No, not yet. Not yet. I mean, for one thing, the Treasury bill buying, that doesn't happen until the 12th. That doesn't start until the 12th. And even when they start doing that, and that's money printing, it takes time for every new dollar printed to first circulate through the economy. Then it winds up in the hands of someone who wants to save it. And that person who wants to save it either puts it into financial assets themselves, or they put it into a bank that does it for them. That process can take time. So we may not see the positive effects of this, probably not even until Q3 of 2026. That's where I'm saying I know for sure we will be in a bull market, barring anything crazy. Like, things just stay as they are right now. I see zero reason why we are not in a bull market in Q3 2026. Unless we have a war or something else happens. Who knows? Right? Could always be something to mess that up. But all things being equal, we should be in a bull market at that time. And the reason I say that also is just because the sell pressure that we're experiencing and going to experience for the next few months should all be gone by then. Because all those 4-year fundamentalists, they'll have been all dipped out. They will have all sold and be like, oh, yeah, we were right. Because look at Bitcoin, it's done. Because it's that simple, right? Oh, number go up high. That means we in bond. Number come down. That means we in bear market. And the cycle's all over. That's how they think, isn't it? Next question here. Crypto Durgan asks, when do you believe the bull market will start? Or are we just waiting for money printing? We are waiting for money printing, yes. And I think that we're in the heat of it come Q3 2026. It's possible that it can start before then. You will know when we are in the bull market because I will be doing a stream that is going to be a very explicit stream where I'll be saying more cuss words than I've ever said before. And I will be we'll be celebrating that we're in the bull market. We'll be celebrating on that stream. We'll be popping the champagne and everything. You'll hear me 1,000 times do this. Woo! And you're going to be saying to me, hey, Cairo, do this.
Control yourself!
But no, I'm not going to control myself. I am going to be calling a lot of people out by name, and I will be destroying reputations. I will be ripping to pieces all of the bears and four-year fundamentalists that have been incredibly disrespectful to me and talking lots of trash about me. I will be doing that. And also, you know what else I'm going to do? You're going to see me dancing on my pole. You're going to see me on the pole dancing on that stream when the bull market begins. All right? You will see that to celebrate the start of the bull market. It has not started yet. Next question here. I got a whole bunch of chats here, more than they usually get. All right. Digital Donkey asks, when alt season, Cairo? Well, first we got to be in a bull market, and then we got to have Bitcoin post its new high, not just in price, but also in dominance, and then that dominance has to come down. When Ethereum has surpassed $5,000, that's when we are in the alt season. Not before, but after we have passed it. Let's see. There's a question here, trying to decipher what this question is. Long TLT and ZB? Is that zero bound? Is that what you mean by ZB? Zero bound? I mean, a TLT is the Treasury ETF. I don't think I want to be long that, though. At least not yet. And then he also asks, or is that short term only? Well, TLT is all the treasuries. There's a bunch of them, like the whole line. Yeah, the entire yield curve is on there. Wonder if Richard is watching right now. It says, Allurman fam? Well, I wish he was watching me, but don't think he watches me. Unless you're talking about like the presser from earlier. Was he watching that? It could be. And next question comes from Found Wanting 369. He says, is the money printer turning on the same thing as the Fed expanding their balance sheet? Yes. Yeah, when the Fed expands their balance sheet, that is money printing. Because what they're doing is they are taking money, not physically printed, but it comes out of thin air. I mean, all it is just numbers in a computer. They're taking that money, though, numbers in a computer, and giving it to banks and taking from those banks bonds like treasury bills or treasury bonds. So that money goes to banks. Banks have more money to lend out into the real economy. And the lending that they do with that money is what expands USM2. All right, next question. Tablarus. He says, why are they so insistent to choose hawkish replacements and keep people like Lisa Cook too? I mean, we're not going to like this answer, but it's a truthful answer. The reason why anybody at the Fed is hawkish and why they don't want to turn on the money printer, because Don't they invest, these Federal Reserve Board governors and everybody that sits on the FOMC? Don't they invest too? Don't they want their investments to do well? And then if they turn on the money printer, the investments do well? Yes. But it also will cause inflation. This is an uncomfortable truth that we do got to come to terms with here as crypto investors, and that's this. We will make a lot of money. We will be rich when it's all over. But everybody who's not invested, they will not be rich. And their lives will practically be ruined. I like to kid around a lot, but I'm real serious about this. You will be rich if you are in crypto or if you own assets. Everybody who doesn't, their lives will be ruined. Because there will be massive inflation that they're just not going to have the means to get over. So it's great for us when the dollar weakens and money is printed and capital gets pushed into assets because we own them already, so we get the appreciation. Sucks for everybody else. When you're the person that has the switch to the money printer and you determine whether it goes on or off, you also got to live with the fact that you're ruining lives when you do it. The people that you're helping, most of the people that you're helping by doing that are already rich. That's why we have hawks on the Federal Reserve. NJ Dub asks me to rate RH's stripper pole skills on a scale of 1 to 10 using your professional expertise. Well, his form is bad. Man, I can't rip on him because he's obviously not a professional pole dancer. He's not a competitive pole dancer or a stripper like I was. So of course he's not going to have good form. You see, the thing about form is that you got to know how to really keep your ankle pointed. You got to keep your knees straight and lock them straight, and that's really tough if you're not used to. Nobody's used to doing it until they get into the regular habit of doing it. So I'll give him a solid 5 because, at least he knew some of the moves, but he just didn't have good form. You'll see good form when we're in the bull market, though, because I will do one of my stripper routines for you guys. I'm late in the stream, but Cairo, do you think there is any validity to the theory that Trump wants to amass more gold in the U.S., then revalue it? I heard that the Genius Act plays into this as well. Yeah, there's we'll talk about this on our stream here, because it is something worth discussing, and that is a form of backdoor QE, because there is gold on the United States' balance sheet that is currently valued at a criminally low price. I think it's valued at $35. And all they got to do is just revalue it. And that gives them a lot more leeway and room to work with at the Treasury. A little more complicated than that. So we'll certainly talk about that. It is a possibility. Don't want to speculate on that one too much, though, yet, because nobody's talking about doing it yet. So that question comes from Daniel Villalobos. Do we got anybody else here? Any other questions? Checks my pulse. Says just getting off work. What's the word? It was 25 basis points. Are these wars, this comes from Sunlight Live, are these wars, such as Ukraine, Russia, and Israel, hurting America financially? Well, the Israel war is over, so no. And the Ukraine-Russia war, that's more of Europe's problem than our problem, but it can eventually become our problem. Definitely hurting Europe, and that's something I'm going to have to cover in our stream. I'm already over 2 hours here, so I can't stay on all day here. But absolutely, it can cause problems. It hasn't caused problems for us just yet. I mean, a way that it hurts the world is the price of natural gas goes up because Russia plays very heavily in that market. And until there's peace, we see them not playing very nice, and especially because Europe is so heavily dependent on natural gas, and Europe really wants Ukraine to win that war. Because you see, the situation out in Europe is that they consume 38 exajoules of natural gas, but they only produce about 5. So they got to get that 33 exajoules somewhere else. Russia has a hand in that. So it definitely hurts Europe, and that's going to be a thing here. It's like, now that the United States has turned on its money printer, I think it's also possible that we see Europe turn on their money printer as well. I mean, one, because they're just going to need to, but then two, it's also because they have bigger problems out there. They got real big problems out there in Europe, and it's the only tool that they got left because they're not going to win the war. Not going to win a war. All right, you guys. So that's all I got for today here. Let's check the market one more time, actually. Let's check the market. Where are we at here? 92,500. So we're kind of like right back to where we started. Not just for the meeting today, but also on the year. Everything is kind of like right back to where it started in the three majors: Bitcoin, Ethereum, and XRP. Give it a little bit more time right here. Me, personally, I'm still stacking stables until the whole carry trade fiasco finally gets settled. We should have some resolution to that come December 22nd. December 22nd, I think we'll have an idea of what's going on with that. All right, you guys. So thank you for watching, and here's a little public service announcement. Why does crypto suddenly explode into unbelievable bull runs, only to crash just as fast? It's not luck. It's not random. It's macroeconomics. In Decrypting Crypto, you'll uncover the hidden forces driving every major crypto rally, forces tied to the global debt machine, central bank liquidity, and repeating market cycles. This isn't another blockchain basics book. This is the blueprint Wall Street doesn't want you to read. The playbook that shows you why crypto moves when it does, and how to spot the next bull run before it starts. Don't miss the next cycle. Read Decrypting Crypto. Arm yourself with the knowledge to ride the wave before it leaves you behind. Decrypting Crypto by Cairo Code. Available now on Amazon and Audible.